In the mid-2000s, a Munich-based company called Wirecard seemed like the future of finance. They were pioneers in digital payments, processing transactions for everything from online shopping to adult entertainment and gambling sites. For investors, they were the German PayPal, a tech darling poised to disrupt traditional banking. By 2018, Wirecard had achieved the unthinkable. It replaced the legendary Commerzbank on the DAX-30 index, placing it among the 30 most valuable companies in Germany. Its market valuation hit 24 billion euros, making it more valuable than Deutsche Bank, a pillar of the German financial system. But beneath the surface, things were not adding up. Journalists at the Financial Times, led by Dan Makram, began noticing oddities in their financial statements. They questioned how Wirecard claimed to be making massive profits in Southeast Asia while using third-party partners to process the majority of those transactions. Wirecard's management, led by CEO Markus Braun, aggressively hit back. They didn't just deny the allegations, they hired private investigators to track the journalists and even filed lawsuits against them. The company insisted they were the victims of a coordinated short-selling attack by market manipulators. The heart of the mystery was 1.9 billion euros. Wirecard claimed this cash was held in escrow accounts at two banks in the Philippines. It was supposed to be the safety net for their payment processing business. But there was one major problem: those banks didn't seem to have the money. The German regulator, BaFin, did something controversial during the investigation. Instead of focusing solely on Wirecard's books, they banned the short selling of Wirecard stock. This effectively protected the company's share price from falling, fueling the belief among many that the regulators were on the company's side. In June 2020, the House of Cards finally collapsed. The company's auditor, EY, refused to sign off on the annual accounts, stating they couldn't confirm the existence of the 1.9 billion euros. The Philippines Central Bank also confirmed that the funds never entered their banking system. The fallout was immediate. Markus Braun resigned and was soon arrested. Wirecard filed for insolvency, revealing that the 1.9 billion euros had likely never existed. It was a massive accounting fiction, created to make the company appear significantly more profitable than it actually was. The scale of the deception was shocking. Investigations revealed that much of the revenue Wirecard reported was generated by fake transactions. They had been inflating their numbers for years to keep the stock price high and maintain their reputation as a high-growth fintech leader. The coup Jan Marsalek, who was allegedly the mastermind behind the Asian operations, disappeared. He remains one of the world's most wanted fugitives, leaving behind a trail of unanswered questions about how he managed to evade authorities so successfully. The Wirecard scandal wasn't just about bad management, it was a systemic failure. Regulators, auditors, and investors all missed the red flags that had been hiding in plain sight. It highlighted the danger of trusting growth stories without verifying the underlying cash flow. The key lesson here is the importance of financial skepticism. When a company's business model is too complex to understand or its profits seem disconnected from its actual activity, that is a red flag. Wirecard reminds us that even the most prestigious institutions are capable of being deceived by a well-crafted lie.